Welcome to The Explainer. So glad you're here because today we're diving into a market that is undeniably popular, visually captivating, but let's be totally honest, it's an absolute minefield for new traders. We're talking about gold, specifically the XAU/USD pair. So let's just jump right in and decode exactly how this market actually behaves, so we can stop guessing and start trading with some real structure. Right off the bat, we got to address the elephant in the room. Why is gold practically famous for being the #1 account blower for retail traders? Well, it boils down to emotion. Gold is an incredibly emotional asset with absolutely wild volatility. People see that shiny metal on the chart and, they treat it like a casino. They jump in hoping to get rich quick, without a solid plan, and boom, those aggressive pit movements just wipe them out. To actually survive trading gold, we've got to ditch that gambling mindset completely and apply a real top-down structured approach. Which brings us to our first core concept, the psychology of gold as a historical safe haven. Listen, before we even think about opening a chart, we have to grasp the centuries-old psychology that drives this asset. By definition, a safe haven asset is one that's expected to retain or even increase in value when the broader markets get turbulent. Think about it like this. When the world is feeling optimistic, traders sell off their gold to go buy riskier assets, like stocks. But the second fear hits the market, like during those massive crashes between 2008 and 2010, people completely panic and they flock straight to gold. If you don't have a pulse on the current global fear levels, honestly, predicting gold's long-term direction is basically impossible. Moving on to our next piece of the puzzle, the fighting cousins, gold versus the US dollar. Here's the deal. You simply cannot trade gold in a vacuum. Why? Because gold and the US dollar share a massive, tight, inverse correlation. Generally speaking, it's like a giant seesaw. When the US dollar strengthens, gold weakens. And conversely, when the dollar takes a hit and drops, gold shines and pushes higher. Now, do they move perfectly opposite to each other literally 100% of the time? No. But that inverse bias is so incredibly strong that you absolutely have to be watching the dollar if you want to effectively trade gold. Alright, let's talk strategy. Pillars 1 and 2, sentiment and fundamentals. The really smart trading starts entirely underwater with macroeconomic drivers way before we ever look at a candlestick. So for our first pillar, sentiment, we pull up the COT report. That's the Commitments of Traders report, and it tracks the active market positions of the massive institutional money. What we're doing here is practicing contrarian framing. We want to align ourselves with the smart money and actively avoid getting sucked into retail FOMO. If you see the retail crowd blindly chasing some massive green candle, that's our cue to be highly hesitant about joining them. So once we've checked sentiment, we shift right into Pillar 2, fundamentals. We have to demystify how real-world, big-picture economics actually push gold around. For instance, if inflation is high and rising, historically, that's bullish for gold as it acts as an inflation hedge. But what if the Federal Reserve is actively raising interest rates to fight that inflation? Well, that strengthens the US dollar, which, as we just talked about, is bearish for gold. And a positive global economic outlook, also bearish. The trick here is combining these factors to build your fundamental directional bias. And that perfectly sets up Pillar 3, technical execution. Notice how we only arrive at the technicals after we've established our fundamental bias. Technicals are strictly for timing your entries and exits. Think about the chronological progression here. Step 1, sentiment analysis. Step 2, fundamental check. And finally, Step 3, technical execution. By strictly forcing yourself to follow this exact order, you literally eliminate cognitive overload. You already know if you're buying or selling based on the broader economy. The charts are just there to tell you exactly where to pull the trigger. And when it does come to those technical triggers, keep it incredibly simple. Seriously, we're looking to trade pullbacks within established, strong trends. You can easily filter that directional flow using your 50, 100, and 200 moving averages. From there, it's just about spotting simple retests of key supply and demand or support and resistance zones. And hey, if you want a little added confluence, you can layer a Fibonacci retracement level right over that area. That's really it. No fancy magic indicators required. But here is where the psychology sneaks right back into play. As our source material beautifully puts it, if you catch a winner, hold on to that thing for dear life. Gold trends can be absolutely massive, meaning you need the psychological endurance to actually let your winners run. Are you going to endure some occasional, really annoying stop-outs along the way? Oh, for sure, that is just part of the game. But holding on to a valid trade and letting it run is exactly how you capture those life-changing big moves. Which brings us to a harsh but necessary reality check, essential risk management. Look, absolutely all of this brilliant analysis we just talked about totally useless if you don't survive long enough to actually apply it. So here is your golden rule of survival. Never, and I mean never, risk more than 1% of your account on a single gold trade. Sticking to this ensures that even when you hit a losing streak, because you definitely will, you are completely protected from catastrophic account-destroying losses. And to realistically execute that 1% rule, we've got to look at the sheer mathematical reality of trading gold. Because of how wildly gold pips move, plus the cost of the broker spread, you really need a minimum of $500 in your account just to safely open a micro 0.01 lot size position. If you're out there trying to trade gold with 50 or 100 bucks, the spread alone is going to eat up your entire risk parameter. It's a mathematical fast track to the poorhouse. So please take this seriously. Backtest your fundamental and technical plan. Get out there and demo test your strategy with fake money before you ever risk a single dime of your real capital. You have to do the hard, boring work that no one else wants to do. Treat it like a business. Don't just gamble. So I'll leave you with this final thought. Are you ready to stop gambling and start trading gold like the institutions actually do? Because by checking sentiment, aligning with macroeconomic fundamentals, and then simply using technicals to pinpoint your entry, you completely flip the odds in your favor. Get out there, start tracking the dollar, keep an eye on those inflation rates, and test this top-down framework out for yourself. Thanks so much for joining me on this explainer, and I will catch you next time.